Welcome everybody to our session on financial management. In the preceding sessions we have learned a lot about the various functions of corporate financing decisions, and we are now ready to apply our knowledge with respect to a small case study. And this is the topic for today. Case study in corporate finance. To be more precise, we are looking at a situation where we have a financing decision of an leveraged buyout via bonds with so-called reset clause. What is the practical background for this case study? We are looking at the food and tobacco company RGR Nabisco. This was created in 1985 through the purchase of R.J. Reynolds by Nabisco, and some years later, in 1988, the investment company Kohlberg, Kravis and Roberts and Co. company KKR, in what follows, bought RGR Nabisco through a leveraged buyout, a so-called LBO, and this was the biggest LBO at the time. So, first of all, we have to explain what an LBO is, or what it looks like. A leveraged buyout is a takeover of a company, or a part of a company, by external or internal investors, and the purchase price is mainly financed by issuing debt. Therefore, it's called a leveraged buyout. So, the first part of the definition refers to a buyout, the takeover of a company or part of a company, and the second part refers to the attribute leveraged. There were two competitors in this specific case. KKR prevailed over an RGR Nabisco management team by offering the former shareholders bonds with a reset clause. And therefore we are looking at this specific feature of the bonds offered by KKR to the previous shareholders. Here you can see some more details with respect to the different offerings. KKR offered $81 per share in cash, and the management's bid was even higher, $84 per share in cash, and both offered bonds valued at $28 each per share. But the main difference was that here, in the case of the KKR bid, we have this reset feature. Therefore, although the overall offer with $109 per share for the previous shareholders was smaller than the offer by the management, $112 per share, KKR won the bid. As I've already told you, this was one of the biggest takeovers at the time. $109, $81 in cash, $28 in bonds, so overall $109 per share. There were about 223 million of common shares, so if you multiply this price per share with this number of shares, you get a total amount of 24 billion of dollars, and about 7 billion of this overall amount was financed by here this debt with reset clause. So, what is a reset clause in this context? It's a specific feature of a bond with the following properties. If the market value of the bond which has been issued with this feature falls below its nominal value on a specific date, which is pre-specified, then the interest rate, the nominal interest rate of this bond is increased to such an extent that the market value goes up once again to meet the nominal value, which was higher in the beginning than the market value. And therefore we call it a reset, because this increase in interest rate leads to a reset with respect to the market value of the bond. It's once again identical to the nominal value of this bond. So if we have a nominal value of 100 euro or dollars per bond, and the market value goes down to 90 dollars or euro, then there will be an increase in the interest rate for this bond until we reach once again the $100 nominal value starting point. We will look at this feature in somewhat more detail later on. Nevertheless, apparently there are two different questions which now arise with respect to this transaction. First of all, under which conditions is such an LBO favorable for the bidder? And secondly, our main questions, what do we think of bonds with such a reset clause as an instrument of corporate financing? Is this a good idea, a bad idea, and why? So we'll first take a look at question number one, when it is a good idea to undertake such an LBO, and secondly, what do we think about financing such an LBO with a reset clause. Now we take a closer look at the leveraged buyout, which is a starting point for our analysis. A leveraged buyout leads to a considerable change in the capital structure of the company, because we reduce the number of shareholders from very many, with only small amounts, to only just a few who hold all the equity shares. And at the same time, because it's a leverage buyout, there is a considerable increase in company leverage. So two main consequences of this leverage buyout, which are connected to corporate capital structure. First of all, a considerable reduction in the number of shareholders, and secondly, an increase in company leverage. Obviously, we are talking about financial consequences, and therefore a leverage buyout can be evaluated in the same way as other kinds of financial activities. And from our previous topics, you know what we do to address such a problem. We are looking at the main functions of corporate capital structure choice and try to find out what are the consequences of this specific measure under consideration, so here this leverage buyout, with respect to these different financing functions of corporate financing decisions. You know the transformation function, the allocation function, the disciplining function, and the signaling function. So first of all, we come to these functions. We will mainly take a look at the transformation function, the disciplining function, and the signaling function. The allocation function, you know, is connected to the trade-off theory in its basic form. Here we have a trade-off between bankruptcy costs and tax considerations, but this is not the main point here for this leverage buyout, so we can skip this financing function. Transformation function has different dimensions. You know, we are looking at maturity, we are looking at the size of the financing decisions, but mainly we are looking at risk-sharing considerations. And in fact, the risk-sharing effects of an LBO are not good, because instead of sharing the risk among many different shareholders, we turn to a situation where we have only a few shareholders which have to bear all the risk. So we have adverse risk-sharing effects due to only a few shareholders left after the LBO. However, with respect to incentive problems, this means with respect to our disciplining function of financing decisions, now we have 2 times this, so only 1 time. There may be a good effect, because obviously incentive problems of external equity financing are reduced, because first of all, it's easier for a small number of shareholders to control management instead of a large number of shareholders. And secondly, we have a higher debt financing, and this higher debt financing also leads to reduced opportunities for management to abuse the profits of the firm for their own purposes, so for perquisite consumption. Nevertheless, the high amount of debt financing may lead to problems, agency problems of debt financing. So, when will an LBO a good idea from this point of view? It will be a good idea with respect to incentive problems if you are looking at firms which have as a main problem the perquisite consumption of their management, because this change in the corporate capital structure reduces, obviously, problems of perquisite consumption. In particular, overinvestment problems in the form of empire building are reduced by this kind of financial restructuring, which is induced by the LBO, because free cash flow problems will be diminished as a consequence of the high debt financing amount and the smaller number of shareholders. So if we look at an LBO from this financing perspective as a measure to restructure corporate capital structure, then it's a good idea if we are facing as a target a company with incentive problems which mainly stem from external equity financing. And if these incentive problems are really severe, they may be more important than the unfavorable change in risk sharing as a consequence of this LBO. Or to put another way, it's not a good idea to target for an LBO firms with very good investment prospects, because the high debt financing amount may lead to underinvestment problems, as you have learned in the previous session. So, this means we are mainly interested as targets for an LBO in firms which have only restricted access to good new projects. And therefore their main problem is a problem of free cash flow. There is much free cash flow, but no good opportunities to invest. And therefore we have severe problems of, at least potential problems of, managerial perquisite consumption. Here we summarize this idea. Proper targets for an LBO regarding the agency problem dimension are companies which have already completed their primary growth phase, so there aren't any good investment opportunities left, at least not so many, and which therefore, because they have invested in the past and they have invested successfully, and therefore they only have a steady cash inflow but don't know what to do with the money. So we have a firm with a steady cash inflow from generally stagnating markets, markets with no significant growth potential, and therefore without good investment opportunities for the future. And we call such companies cash cows. You may know this term from the product portfolio metrics developed by the Boston Consulting Group, which is also called the portfolio growth share matrix. And I will just try to show you the main idea of this matrix. We have two dimensions, and we now have on the horizontal axis the relative market share of a company or a business unit, and on the vertical axis we have the market growth. Now I just write it one more time. Here we have the market growth. And now we simply divide the whole diagram into 4 squares, and here we have a low market share for our company, here a high market share, here we have a low market growth, and here we have high market growth. And according to Boston Consulting Group, we call companies or business units allocated in the upper right as stars, because they give us high relative market shares and high market growth. That's fine. It couldn't be better. Low market growth but high relative market shares are called cash cows, as I have already explained to you. They give us steady cash inflows because we have high relative market shares, but we don't have any considerable, significant or relevant market growth opportunities, investment opportunities for the future. Here we have dogs, poor dogs, low market share, low growth opportunities, or we should disinvest these business units or companies. And here we have question marks because we don't know what to make out of them. Hopefully they become stars, but without luck they may turn to dogs. So nevertheless, we are not mainly interested in the background of this product portfolio matrix conceived by the Boston Consulting Group, but I simply wanted to remember you that we have here our cash cows. So these cash cows are a very suitable target for leveraged LBOs, because by buying out or acquiring these cash cows with a lot of leverage, we can use the agency problem of external equity financing, the free cash flow problem, stemming from the high relative market share and the low growth opportunities. And this will lead to positive valuation effects with respect to these cash cows. And they will overcompensate our adverse effects for risk sharing. So all in all, this is true for RGA Nabisco, because here we have obviously a firm which is operating on markets with only low growth rates, because they are selling, as you can see here, tobacco and food. So there's not much left of market growth, at least in most of the developed countries. But they have a relatively high market share, and therefore they earn good and steadily sufficient money. And this means Arch Nabisco indeed was a good target for a leveraged buyout. I think this is not very surprising, because this investment company is doing such business all the time, and they know what are good targets for buyouts and what are bad targets for buyouts. So, however, we can understand this decision, why Arch Nabisco is a good target for a takeover activity due to its specific features. So let me see. This means our first conclusion is this is true for RJR Nabisco as a food and tobacco company. Okay, this was with respect to the disciplining function of financing activities. There might also be a signaling component, because as a consequence of the sharp increase in the leverage ratio of the firm, bankruptcy risks go up. And therefore we might interpret this increase in company leverage as a good signal, because only good companies are able to handle this higher leverage ratio with respect to their bankruptcy risk. So if you're looking at a firm and you learn that they increase their leverage, then you know that only a management which is optimistic with respect to the company's earnings is able to do this without risking the bankruptcy of this firm. So therefore the signal is credible, because a bad company, a company with only poor earnings forecasts, will not risk to do the same, as the risk of bankruptcy would increase too much, and therefore the management of this firm would be afraid of losing their jobs. So therefore, increasing the leverage of a firm might be interpreted as a good signal, and may tell us that this company is considered to be good, at least by its management. However, so this explains why the signal is credible, because imitating the signal by bad companies is not advantageous due to the excessively high bankruptcy risk which these bad companies are facing after this adjustment of the leverage ratio. However, it's difficult to judge firm quality for external parties, and KKR was an external party. So if the bid had been won by the RJR Nabisco management team, then indeed the LBO might have been interpreted as a good signal. However, here we have an external party which took over RJR Nabisco, and therefore the signaling in the argument is not sufficient plausible, because it's hard to believe that KKR has insider information with respect to AirJoy and Nabisco, which is of the same quality as the management's information. So signaling might be a point, but only if there are insiders at work who have superior knowledge with respect to the company profits, but this seems not very plausible with respect to the takeover by AirJoy and Nabisco. So this means this should not have played a major role in this specific case which we are looking at. Summarizing so far for our LBO, from a financing point of view, we have mainly adverse risk-sharing effects, but good incentive effects, at least for companies which we may categorize as cash cows. Cash cows are companies with high cash inflows from stagnating markets. This was true for AirJoy and Nabisco because it was a food and tobacco company with stable income, but without very much growth potential. So this should have explained the main reasons for this takeover activity and why AirJoy and Nabisco had become the target of these measures. In the same way, we are now looking at the reset clause. This reset clause is sometimes called, or is sometimes interpreted as an insurance feature for a bond, because if the market value goes down, interest rate goes up as to re-establish the previous level of the market value. And seen from this point of view, we might think of good risk-sharing features of this instrument. So once again, we are looking at the transformation function, and once again, we are mainly interested in risk-sharing considerations, but this idea, concluding from some kind of insurance feature of this instrument to superior risk-sharing properties of a bond with a reset clause, is not right, because we have to look at the risk which is borne by all the investors. And if there is a bond endowed with this kind of reset clause as an insurance feature, then risk is transferred from the debt holders to the equity holders. Since, as you have just learned, in certain situations, interest rates for this bond go up, and this means there is less money left for our equity holders. So there's simply a switch from the equity holders to the debt holders with respect to money, and from the debt holders to the equity holders with respect to risk. Whether this kind of risk transfer is beneficial from an overall point of view, so if it is an efficient way of risk sharing among all investors, it's not clear at all. It might be a good idea if we assume that our shareholders are less risk averse than our debt holders, which might be in most cases true. However, shareholders already bear more risk than debt holders, and after establishing such a reset clause, they are bearing even more risk. And it's not clear at all that such an excessively asymmetric distribution of risk sharing is really efficient. So just to conclude for this first consideration, although we may characterize a bond with a reset clause as a bond with some kind of insurance feature, this does not mean that this bond with reset clause is superior from a risk-sharing point of view, because we must not overlook the problem that the risk of the firm does not vanish, but is simply distributed in a different way. It's transferred from our debt holders to our equity holders, and it's not clear that this is really an efficient way of risk sharing. So from the risk sharing point of view, it's not really clear whether a bond with a reset clause is a good idea. And this means we have to look in somewhat more detail at potential incentive problems of bonds with such a reset clause. In order to understand the behavioral consequences of a reset clause for a market, for a bond, we first have to take a look at the reasons why there might be a reduction in the market value of a bond. As you know, we may describe the market value of any financial instrument as the expectation value of the cash flows for this instrument. For example, here we have only a 2-date model with CF1 at time t equal to 1, and this is discounted at the corresponding cost of capital for this financial instrument, so we divide it by 1 plus R. When will this market value decrease? It will decrease if market interest rates go up, because in this case we will also see an increase in the cost of capital for this financial instrument, because market interest rates enter as one determinant this cost of capital, and the market value will go down if we have an adverse development of the borrower's creditworthiness. So if expectation values for cash flows go down, or as a consequence of the higher risk of this bond, the cost of capital go up, we will also identify a reduction in the market value of this financial instrument, this bond. So these are the two reasons why we might observe a reduced bond market value. There might be a decrease of the numerator or an increase of the denominator. There are two different effects connected with a reset clause for a bond. The first one might be called an ex-ante effect. It's an effect which is relevant even before the reset takes place or might take place. And there might be a second effect which is called the ex-post effect, and this is relevant after there has been a reset. So first take a look at the ex-ante incentive effect. So how is managerial behavior influenced even before there is a reset? Apparently, such a reset increases the debt obligation of the firm. So it's not in the interest of the shareholders and therefore the management, if we assume that the management, at least here in the case of the LBO, acts in the interest of the shareholders, because we have a small number of shareholders who are able to control our managers, then they will not like such an increase in the interest rate, such a reset. So to put another way, if management or shareholders do something which is not in the interest of the debt holders, if they try to enrich themselves at the cost of the debt holders, and this leads to a reduction in the creditworthiness of the company, then we will observe a reduction in the market value of the bond, and in turn an increase in the interest payment obligation. And this is some kind of penalty for managerial misconduct, and therefore will have an effect like some kind of disciplining mechanism, and therefore reduce the incentive to behave selfishly at the cost of our debt holders. So, in the ex-ante perspective, there is a disciplining effect of reset clauses, because reset clauses become relevant if there is a reduction in the borrower's creditworthiness, for example, as a consequence of managerial misconduct, selfish behavior, and this penalty will, in the ex-ante view, prevent management from taking such adverse measures at all, because they know there will be some kind of punishment in the form of advantages, an unfavorable reset. So reset clauses may help to fight agency problems of debt financing, as we have learned in the previous sessions. What kinds of agency problems of debt financing are existing. However, as we have also learned in this session, typical target companies like Arch and Nabisco are not companies with large agency costs of debt financing. Instead, they have typically agency costs of external equity financing, because companies with large agency costs of debt financing, which are facing underinvestment problems, for example, due to the high leverage, would even make the incentive problems worse if there is a leverage buyout undertaken with respect to them, because then the leverage ratio would go up even more and we would have even stronger agency costs of debt financing. So as you know, we are typically aiming at companies which face agency problems of external equity financing, and therefore this ex-ante effect of reset clauses, which reduce agency costs of debt financing, is not really relevant for such companies. Okay, so the ex-ante incentive effect of reset clauses may reduce agency problems of debt financing, but this is not really relevant for the typical targets of leverage buyouts, because these targets are mainly characterized by agency problems of equity financing, because these problems can be mitigated by the leverage buyout. Therefore, we now turn to the second effect, the ex-post incentive effect, which only becomes relevant after the reset. And this incentive effect is really bad, as we will see now in this numerical example. We take a look at a bond with a debt claim of 106 monetary units at time t equal to 1. The nominal value of the bond is 100 monetary units and the nominal interest rate is 6%, and the product of these two nominal values gives us the total debt claim. There shall be only two states of nature at time t equal to 1, and our cash flow can be 140 monetary units with a probability of phi and 90 monetary units with a probability of 1 minus phi. We assume that all our market participants are risk neutral, so we only look at expectation values of future cash flows and discount them at the riskless interest rate. but we also assume that the riskless interest rate is identical to 0. So due to our assumptions, we have no risk premium, which has to be determined. The risk premium is near 0 because of our risk neutrality assumption, and there is no positive or no riskless interest rate which is different from 0 due to our second assumption. Therefore, we get a very simple formula for our market value of this bond. We have only to compute the expectation value of the future payments, and this means we have phi times 106 for the good state of nature, because here we have enough cash flow to pay back the debt claim, and 1 minus phi, this is the state of bankruptcy, times 90 monetary units, because in the second state of nature there's not enough money left for paying back the complete debt claim. And now we look at different situations with respect to phi, which characterize different situations with respect to the creditworthiness of our company. First of all, if we have a rather high value for phi, then we see we get exactly a market value of 100, which is identical to the nominal value of the bond. This means the price is equal to par. And what have we computed? 0.625 times 106 plus 0.375 times 90, and this gives us 100. In the second situation, the probability for the good state of nature goes down, so our situation worsens, and as a consequence, if we now take expectation value, we only get a market value of 98 monetary units. And it becomes even worse with probability phi of 0.2, because here we now get, if we one more time compute this expectation value, only 93.2 monetary units. So we have simply varied our value for phi and therefore for 1 minus phi and get different market values. If there's now a reset clause, then obviously a reset is necessary in these two situations where phi goes down to 0.5 or 0.2. How have we to adjust our nominal interest rate? We have adjusted to 10% in the situation with phi equal to 0.5 and to 40%, even 40% in the third situation where phi has gone down to 0.2. Just to check this statement. So here in B, we assume now an interest rate of 10%. This means in the good state of nature, our debt holders get 110 monetary units instead of 106. In the bad state of nature, there's no change at all. They get all the money which is left. This means 90 monetary units, and this gives us overall a market value of 100, which is identical to our nominal value. In situation C, nominal interest rate is adjusted to 40%. So here, in the good state of nature, our shareholders get everything because we only have 140 units, so we can just pay back our debt with all the interest payments. And our debt holders also get all the money which is left in the bad state of nature, and once again we are reaching a value of 100 monetary units. So indeed, these adjustments, these kinds of reset from 6% nominal interest rate to 10% in situation B and to even 40% in situation C can re-establish a market value which is identical to our nominal value of 100. So, And therefore, as you know, one may call this reset feature some kind of insurance property, because our debt holders seem to be insured against market value reductions. As I've already told you, from a risk sharing point of view, it's not clear whether this is really a good idea, because these higher interest payments have to be borne by our shareholders, and therefore there's only a shifting of risk, but not a reduction of overall risk. However, in any case, there are some incentive problems connected with these resets, because now assume that in order to realize the investment opportunity which leads to these payments of 140 in the good state of nature and 90 in the bad state of nature, it is necessary to do an additional or initial investment outlay of 16 monetary units after the reset. So after the reset has taken place, the company, the management, or the shareholders have to decide whether to invest 16 monetary units, and only if they invest these additional or initial amounts, this doesn't matter whether it's additional or initial amount, then we will realize these payoffs described on the slide, 140 and 90, depending on the state of nature which is realized. Instead of investing, shareholders can take the money and leave. So it's some kind of agency problem of debt financing, as you know. And certainly, you know, here can be an underinvestment problem. There can be an incentive for our shareholders not to invest at all due to the high debt obligation. And in fact, this is here the case, at least partly, because now look at the payments to our shareholders. In situation A, here we have, I will write it here down, we have no reset, and therefore we have simply 0.625 times 33, the rest of 140, so 140 minus 106, and this gives 21.25, which is larger than 16, and therefore it's in the interest of the shareholders to invest. So here they will really invest, and this is good news for the debt holders as well, because they get in expectation value 100 monetary units in situation A. In situation B, after the reset, we have only a reduced probability 0.5 for the good state of nature and an increased interest rate. This means there are only 30 monetary units left for our shareholders. This means 140 minus 30. And the overall value is 15. This is smaller than 16, and therefore there will be no investment at all. And this means instead of getting in expectation value 100 monetary units, the debt holders will get nothing at all because there will be no investment. So this is a bad situation for the external investors, the debt holders, and they are not protected by any kind of insurance feature against an underinvestment of the debt holders. I think it's clear in the third situation, situation C, the things are even worse, because now we have 0 payments to our shareholders, and therefore they will not invest either. This means in a situation with a bond featuring a reset clause, only in situation A there will be an investment by our shareholders and therefore positive payback to our equity holders. Things are different if there would be a clause without a reset. In this situation, this here would be the same as with a reset clause, because there is no reset in situation A. However, in situation B, without a reset clause, instead of getting only 30 monetary units, our shareholders would get 34, because we are still left with a nominal interest rate of 6%, and this means we get an expectation value for the payments to our shareholders of 17 monetary units, which is larger than 16 monetary units. So here, in case B, they now will invest. And this is good news for our debt holders, because now they get more money than in a situation with a reset clause. And this looks some kind of counterintuitive, but it's a consequence of the adverse behavioral consequences, effects of the reset clause. In situation C, there would be no change at all with or without reset clause. So here, this is an important case. We have to compare these two situations. Just let me take a look at C. Here we have 0.3 times 43, and this is only 6.8, and obviously smaller than 16. So here we will have no investment as well from our shareholders. But nevertheless, here you can see the exposed incentive effect of the reset clause, which is negative, which is not advantageous at all from an overall point of view, because our creditors would get more money without the reset clause. And this is an interesting and important consequence. Here it's summarized. The investment only takes place in the case of phi identical to 0.625 with the reset clause, and it would have taken place as well for phi equal to 0.5 without a reset clause. And this means our external investors get fewer returns after reset than without a reset. And this is a problem for bonds with reset clauses, and obviously this is an argument against reset clauses. Just a short comment on a related phenomenon, which is called credit rationing. The credit rationing problem is interesting as well. It means you might think, if there is a potential borrower asking for a credit by a bank, then if the bank is not willing to grant the loan for a specific interest rate, then it might be willing to hand over the money for higher interest rates. So one would expect that with higher interest rate payments, which are promised, there should be higher loan amounts. And this is not true. In fact, it might be that a firm is not able to get more money from a bank, even if the firm is willing to increase its interest obligation. And this phenomenon, that there is an upper limit for the loan which can be received from the bank, is called a credit rationing phenomenon. Just to show it here with a simple illustration. Here we have the borrowing rate for the credit loan, and here we have the expected payoff for our creditor. The borrowing rate is our debt claim which is promised to be paid. The expected payoff is the average actual payment to our creditor. And if we now increase the borrowing rate, then we can explain that first the expected payoff goes up, and this means our creditor will be willing to grant a higher loan because his or her expected payoff increases as well. But then there will be a maximum value, and after this the expected payoff goes down as well, and therefore it's not possible to get more money from the creditor as described by this maximum. And how can this be? That you reduce your expected payoffs if you get a higher interest claim. The reason is the adverse incentive effects, because with higher borrowing rates, the agency problems of debt financing become more relevant. They become more severe. And therefore we will face stronger problems of underinvestment, of asset substitution, and this will reduce expected payoffs. So the good effect of increasing our debt claim by higher borrowing rates is more than compensated by the negative behavioral effects with respect to the agency problems, leading to the rationing, the credit rationing phenomenon just described here. And a similar effect is at work with reset clauses. And if we have studied the theory of finance, you know something about such incentive effects and would have foreseen this problem when making use of a reset clause for financing a leveraged buyout. So here, our summary: the reset clause for bonds leads to more severe incentive problems in debt financing exposed, especially when these problems have already become more prevalent as a result of the deterioration of the company's creditworthiness, or simply as a consequence of an increase of market interest rates, because these two aspects lead to reduced market values and therefore to a reset. And in such a situation, the overall status of the firm as a borrower isn't as good as before. So here, as a consequence of the exposed incentive effect of the reset clause, incentive problems become worse in situation where we already have some problems, because the reset has been triggered by reduced creditworthiness of the firm or higher market interest rates, as we have learned here. These are the two reasons why we may observe a reset. And both these problems make incentive effects stronger even without a reset, but then in combination with a reset, the problems become even worse. And this may lead to some kind of downward spiral with incentive problems getting stronger and stronger, because as a consequence of this exposed problem, we have more negative incentive effects. Management will do things which are not good for debt holders. This will deteriorate creditworthiness even more, leading to the necessity of an additional reset, and so on and so on. So there's one great danger connected with reset clauses. They are typically induced by negative developments before, negative creditworthiness development for the firm, or negative market interest rate development for the firm. After the reset, at least creditworthiness problems become more relevant due to higher incentive problems, stronger incentive problems, leading to the necessity of one more reset, and so on, and eventually may even lead to the bankruptcy of the firm. And something similar has really happened with RJ Nabisco, because due to bad luck, they had a loss in the first year after the takeover because there were some problems in the tobacco industry. As a consequence, the bond prices fell by 20 points. So instead of 100 as a price, they only had 80, and therefore there had to be a reset amounting to 25%. So the interest rate 25% because we have a gap of 25% from 80, our new value, to the desired value of 100. And this means we have to increase the interest rate by 25%, which means from 15% to 18.75%, so 3.75 percentage points, which is 1/4 here of this, times 15% is equal to 3.75%. So this here should be 0.25. Okay, and implying even higher interest payment obligation and worsening the earning situation even more, leading to more incentive problems and more the higher necessity for additional resets. And all in all, this investment turns out to be not very profitable for KKR. Instead of getting the usual 20% from this investment, they only got 2%. And this was mainly a consequence of this reset clause. Here you can see the downturn of the bond as well, from 100% of nominal value, so to 80% of the nominal value, and a gap of, as seen from here, 25% to the initial nominal value. So, apparently our analysis of the preceding sessions has helped us to understand this problem of the reset clause, this severe incentive problem connected with reset clauses in an ex post sense, and this should also have been obvious for the investment company KKR. And so you see, I hope at least, that the things you have learned here in this course so far help us to understand the advantages and the disadvantages of certain financial activities. And KKR should have seen this as well before they undertook the takeover. To finalize this case study, we can also think of the reset clause as some kind of signaling device, because these incentive problems related to the reset clause might be understood as signaling costs. So the reason is simple. Only good companies are able to make use of bonds with reset clauses, and therefore realizing higher bankruptcy risk, because in the case of bad companies, this danger of a downward spiral is too severe to imitate the good companies. So only good companies are able to make use of these reset clauses because of their limited bankruptcy risk. If they are imitated by bad companies, these bad companies will go bankrupt with rather high probability, and therefore the management of these firms will refrain from making use of these reset clauses because they would lose their jobs. So, reset bonds may be an instrument for signaling a good firm quality. Why? because it doesn't pay for the bad companies to imitate the good companies due to the high bankruptcy risk induced by these reset bonds. However, as we have already discussed in connection with the reasons for a leverage buyout, this is only an argument for leverage buyouts or for reset clauses which have been issued by insiders. But here we have KKR, our external investor, and therefore it's not plausible to assume that they had inside information which enabled them to make use of reset bonds as some kind of signaling instrument. And in fact, as we have seen in the development of KKR, this wasn't a good idea. So they certainly have not foreseen the possible adverse development after making use of this kind of financial instrument. This means reset bonds may be used as a signaling device, but only if you really have sufficiently good information, if you have superior information with respect to the status of the firm, and therefore you have to be an insider to be credible. So, I think you have seen we have learned something in the previous sessions, and we have been able to assess this idea of an LBO with respect to Arch and Nabisco in general, and with respect to issuing bonds with a reset clause in particular. We have done so in a qualitative way. I have not presented to you quantitative data of practical relevance. We have only taken a look at simple numerical examples, as you can see here, but apparently these are not real life data from Arch and Nabisco. And this means we have only been able to conclude in a general way that the LBO was a good idea with respect to Arch and Nabisco, and that issuing reset bonds wasn't a good idea in the same way. So we are able to derive such qualitative assessments, which has some value in itself, but it's not so easy to compute on the basis of the disciplining function and the signaling function of financing activities. And I will return to this aspect at the end of this session, why we can only mainly derive qualitative conclusions, but not quantitative ones. The concept which we have just applied for the analysis of our case study, this means to take a look at the different financing functions and examine the implications for the problem at hand, can also be applied to other financing activities or financial instruments. And therefore I would like to give you another brief example for such an examination. And we take a look at so-called floating rate notes. This is a special kind of debt instrument where the contractual interest rate is adjusted on a regular basis to match the development of a certain reference interest rate which is taken from the market. For example, a typical reference rate would be LIBOR, London Interbank Offered Rate. So it's a interest rate which is relevant for banks in London, or the Euribor is the Euro Interbank Offered Rate, which is an interest rate which is relevant for handling interbanking transactions in the Eurozone. And this means for such a floating rate note, we don't have a fixed debt claim F comprising principal and interest payment, but a stochastic debt claim which depends on the development of the respective market interest rate. Typically, if market interest rates go up, then F tilde increases, and if market interest rates go down, then F tilde is reduced as well. And we can now ask ourselves what could be the rationale for such a kind of financing instrument. And we do so by taking a look at our financing functions. And the most important in this regard are the disciplining function and the signaling function. So there's not so much room to argue on the basis of the transformation function or the allocation function. To understand the consequences with respect to agency problems, think of a firm with an uncertain cash flow CF tilde. And as you know, after subtracting the debt claim F, we get what is left for our equity holders, at least in the case where CF is larger than F. And as we have seen during our discussion of the agency problems of debt financing, for ceteris paribus higher values of F, the agency problems with respect to debt financing become more intense. They become more severe, because then this difference becomes smaller and there is a larger danger for bankruptcy. And you know, the larger the risk of bankruptcy, the more we face incentive problems with respect to debt financing, because there's an incentive, for example, to undertake very risky projects just to arrive at cash flows which are large enough to cover the debt claims of our creditors. So this means we get a more severe asset substitution problem, and the underinvestment problem, for example, as well becomes more relevant. So if we now assume that F is a random variable because the debt claim is a function, positive function of the market interest rate, then if CF would be a constant, we would observe varying differences between CF and F tilde, and in particular it would not be a good idea to use such a floating rate node, because for high interest rates this difference would become small or even negative, and this would mean we are in the domain of potential bankruptcy. However, if CF is a random variable as well, and both random variables are positively correlated, then we know in situations where F tilde goes up, we will also observe, at least in most cases, that CF goes up as well, and both go down in a similar way. This in turn implies that the difference between CF and F stays more or less constant, and therefore the agency problems of debt financing stay more or less constant. So if we have a firm where the future uncertain cash flows are a positive function of the market interest rate development, then a floating rate node would be a good idea for debt financing, because it would reduce the agency problems of debt financing compared to a situation where F is a fixed value. Because in such a situation where we use a straight bond, a so-called straight bond, where F is given, because interest payment obligations are given, we would observe small values for this difference if CF goes down, and large values if CF goes up. And this means we would here observe varying degrees of agency problems of debt financing. So therefore, there are situations where the issue of floating rate notes is superior to the issue of so-called straight bonds with a given market interest rate for all future periods. And such situations are characterized by firms where future cash flows are correlated with market interest rates. Certainly, this is a very specific condition which we have to meet, and it can typically only be observed for banks. So for banks, it's typical to observe such a relation between the cash flow of a bank and the development of market interest rates, because if market interest rates go up, they can earn more money from handing over money to borrowers, to finance borrowers with loans, and therefore it seems to be a good idea for banks at least to make use of floating rate notes for financing their business. And in fact, we can observe such a behavior. We can observe that floating rate notes are used by banks as financial instrument. There's another possibility to justify the issuance of floating rate notes, and this is based on signaling considerations, because if we assume that everybody knows whether the cash flow of a firm is depending on market interest rates or not, so if we assume that this property is common knowledge, then it might be, but we don't know the types of the firm, so we don't know how much each firm earns. We only know whether the cash flow is correlated to the market interest rate or not, and in which way. Under such a condition, it would be a good idea for firms with cash flows that are not positively correlated with market interest rates to issue a floating rate note if these firms are of a good type, so if they earn sufficiently high profits in the future. Because if you look at such a firm where we have CF tilde minus F tilde, but now we have no positive correlation, so maybe no correlation at all, or even a negative correlation. This means we have the problem that if F goes up, CF does not increase in a similar way, and therefore in such a situation the issuance of a floating rate note tends to increase the agency problems of debt financing. This is okay for good type firms, for firms with sufficiently high values of CF, because in this case this difference stays large enough so that there are no relevant agency problems, but it's not quite as good for bad firms where we observe small values for CF and therefore small values of this difference. This means if we observe that a firm issues a floating rate note and we know that cash flows for this firm and other firms are not positively correlated with market interest rates, we may conclude that this firm must be of the good type, because a bad type firm would not imitate this behavior, as this would increase its bankruptcy risk, and therefore the firm management would refrain from making use of this financial instrument, because they don't want to lose their jobs, the managers. So here we have another possible argument why we may make use of floating rate notes. It's just the other way around than the first argument. Based on the disciplining function, we would expect that firms with a positive correlation of their cash flows with market interest rates would rely on floating rate notes. However, if we look at signaling problems, so informational asymmetries with respect to the type of a firm, this means hidden information problems instead of hidden action problems, then it's the other way around, and we would expect that firms where their cash flows are negatively correlated or not correlated at all with market interest rates would rely on floating rate notes, at least if we look at firms which are of a good type, so which have sufficiently high future earnings. This means floating rate notes may help us to arrive at a separating equilibrium on our capital markets with informational asymmetries with respect to the firm type. And the unobservable firm type in this case is described by the unobservable credit rating of our firms, which may be good or bad, and therefore there is an incentive for the good type firms to reach a separating equilibrium. So here you see once again how we can make use of our financing functions to analyze the welfare implications of the issuance of certain financial instruments, here of floating rate notes. And based on these financing functions, we are able to even able to derive recommendations for the issuance of these instruments, because if you're looking at agency problems, and this means the disciplining function of corporate finance, then we would recommend to make use of floating rate notes if a firm's cash flow is positively correlated with market interest rates. So here we are looking at hidden action problems, while in a situation where we have hidden information problems, this means unobservable firm type, then we would recommend the use of floating rate notes for firms with cash flows which are not or negatively correlated with market interest rates. So as you can see here, indeed we have learned something about financing decisions based on the analysis of financing functions. However, we are left with only qualitative recommendations. We have not been able to compute welfare implications in the form of agency costs, for example, amounting to a certain value, a certain amount of euro, for example. And this leads us to our last concluding question: what about quantitative recommendations? In fact, it would be a nice idea to base our analysis of corporate financing decisions on the assumption of a perfect capital market, because a perfect capital market is unambiguously defined by certain assumptions, as you know: no transaction costs, rational behavior, and given prices. And therefore we may talk about some kind of monolithic theoretical foundation of firm decision making. However, there's one big shortcoming of this approach, because as you know from our analysis of the irrelevancy theorem by Modigliani and Miller, on perfect capital markets there's no room for a welfare increasing corporate financing decision. Here we have the irrelevance of corporate financing decisions for the market value of a firm, and therefore we cannot start and not base our analysis of company financing decisions on the assumption of a perfect capital market. What we need is some kind of imperfection, and the problem is there is almost an infinite number of possible imperfections of markets, and up to now no single model of imperfect capital markets is generally accepted as a reference model. So we have different ways to characterize an imperfect market, because there are many different kinds of imperfections, and we are lacking a generally accepted model of an imperfect capital market from which to start our analysis of corporate financing decisions. And this implies that we are not able to determine something like agency costs to compute the amount of money which may be lost by facing agency costs of debt financing or agency costs of external equity financing. And therefore, in particular with respect to the signaling and the disciplining function of financing activities. We are only able to present computations for very specific assumptions. So for very specific situations with imperfect capital markets, like the simple numerical examples from our previous lectures. But we are not able to formulate a generally accepted model which enables us to compute the welfare implications of hidden information and hidden action problems in a practically relevant way. In fact, for the time being, it's only possible to determine future tax payments quite precisely based on corporate financing decisions. But even in this situation, we need a valuation function to determine the market value of future tax payments. And this valuation function must be derived on the basis of an imperfect capital market. And as I just have told you, we are lacking the generally accepted reference model of an imperfect capital market. Problems are even larger for estimating future bankruptcy costs, direct and indirect bankruptcy costs, and once again we would have to formulate to make use of a market valuation function. So regardless of which financing function we are looking at, signaling function, disciplining function, allocation function, or the transformation function, in all these respects, in all these dimensions, we have a problem of presenting practically relevant computations. And this is the main shortcoming of financial theory today. We are able to understand many implications of financing decisions, many welfare implications of financing decisions. We are able to compute them for simple models, but we are not able to present a generally accepted reference model of an imperfect capital market from which to start in order to compute practically relevant welfare implications. When we now turn to corporate valuation issues, we don't have this problem at all, because here it's indeed possible to rely on perfect capital market considerations. Nevertheless, we pay a price because by assuming a perfect capital market for our corporate valuation approaches, we refrain from taking a closer look at corporate financing decisions, because these corporate financing decisions on perfect capital markets are irrelevant, as you know. So we are able to present practically relevant computations of market values, but we will do so on perfect capital markets, and therefore we cannot analyze financing decisions at the same time. And this concludes today's session. And once again, thank you very much for listening to me, and goodbye.